If you're a doctor or high-income professional thinking property is just about owning a home, this conversation is going to challenge everything you thought you knew about wealth building.
Back to one other question about why property is so good. Fundamentally, it's a great hedge against inflation. We've had inflation running really high, but being in the property market, I look back at what I paid for properties 10 years ago and go, wow, I never expected it to be this high today. You've been well ahead of inflation.
So it's better than gold.
Oh, yeah, I reckon.
Most doctors I speak with are sitting on massive borrowing capacity, but they're not using it. Why? Because of fear, because of their mindset, because of analysis paralysis, and it's costing them millions in long-term equity. In this episode, we're joined by Rich Harvey, one of Australia's most respected buyer's agents. With decades of experience helping professionals like yourself go from one property to building portfolios that outperform the market and outpace inflation.
There's 15,000 suburbs in Australia. How do you pick which one to buy in? There's both technical and fundamental analysis. Technical is just all the data points, and then fundamental analysis is really what I call our own applied knowledge.
In this episode, you'll learn why most property investors stall after one or two purchases, how doctors can invest safely without over-leveraging, and the 3 strategic property structures that can unlock exponential growth without compromising your lifestyle. Now let's jump into it. Hi everyone, welcome back to another episode of the Investing for Doctors podcast. We've got Rich Harvey back with us again. Hi Rich.
Great to be with you, B. Thank you.
Welcome back. So recently we had the Investing for Doctor conference at World Square, and in one of the sessions we had a debate. And as you recall, the debate was about stocks versus property. And from memory, the property team got the...
We did win. We did win the debate. I mean, it was a great debate. It was a lot of fun. Okay?
Yeah,
it was a lot of fun. I mean, I think at the end of the day, the message is it's not one or the other. You do both. But At the end of the day, I think sometimes you've got to have a preference for one over the other.
Yeah.
It's not always 50-50, a perfect balance between property and shares.
Yeah.
And there's pros and cons, which we can get into today.
Yeah, absolutely. I mean, it's never a 50-50 because a lot of us are more... heavy on the property side because that's
exactly.
Owner-occupied residences are quite expensive these days, and it's the biggest first investment you do. So I guess as an extension of that session, let's talk about again. Let's bring the debate content into an episode.
Love to. Fantastic. Bring it on. Yeah.
So I guess again. We're not advocating for everyone to go one or the other. It's always going to be a balanced approach. And, a lot of people have exposure to shares and equities in their superannuation by default and property as their owner occupied. But I think the difference is using property as an investment tool. That's kind of different to just, buying a home and living in it.
Exactly.
Yeah. And so what are your takes on that? And, of course, you're a buyer's agent, so you're always going to be a bit biased, but why, make the case for property, again, as you did in the conference.
Okay. Yeah, well, I think a lot of people think property is just something just to have in my own home, right? And that's enough, right? Maybe one investment property. A lot of investors get stuck in that kind of mindset. They don't understand the concept of leverage, of building a portfolio, and just how fantastically secure and safe property is as a wealth creation tool. It's a wonderful tool. So for me personally, it's been a great way to create a nest egg for my family. So I think, a lot of people just have the mindset of like, oh, that's a bit too hard, or kick the can down the road, or let's start investing in when I've got my family set up. But it's too late. If you start investing in your late 40s, you've left 2 or 3 property cycles behind. So it's really good to start as early as possible and get into the game. And I think we'll uncover today that the key message I want to get across to the audience, particularly doctors, is use the leverage you've got. When you're on a trajectory to potentially earn really good income as a medical professional, that's the golden goose. That's what's going to lay the golden egg every year. And not using that borrowing capacity is something that you're going to regret for the rest of your life. So using that borrowing capacity carefully to leverage safely into property can set you up for life quite quickly.
Okay. So, Rich, you mentioned doctors, and I believe, we are a slightly different breed of people. And one of the reasons for that is that we're very risk averse because I call that one of our professional ills because we don't like borrowing money because that's seen as risk. Whereas I've fought long and hard against that ideology because we're actually the people that can take the most risk. And as you mentioned, leverage is something that's very useful because doctors can afford to leverage and actually have safe careers, income streams to afford that.
Correct.
Perhaps I'm leading, in the conversation, but like, do you see that as a major problem in, for doctors that they have this mindset that is a bit aversive towards being leveraged?
Yeah, I think you're right because I mean, your mantra is to save lives, so you're going to do whatever it can to protect and save lives. But you also need to fit your own oxygen mask, right? That analogy of being on the plane, fit your own oxygen mask first before you help others. So you've got to tap into a bloodline or a lifeline or what I call the gravy train of property wealth, right? And I had a fear of debt, right? I go back to my own example, like. I speak to a lot of doctors that they have a fear of a debt. They've paid down their home loan, they're in a good position, got a fantastic income, but they're not taking the action. And I'm asking the question, what's holding you back? And that's a good question to ask the audience that's listening to this today. What is holding you back? Is it a mindset thing? You're worried you're going to over leverage and can't pay the money back. Well, property can become self-sustaining quite quickly. Yes, it's a mind shift to take on, $3 to $5 to $10 million worth of debt. But when you look on the other side of the equation, you might have, $5 to $10 to $20 million worth of equity in a couple of years if you invest smartly. So I think, doctors are very risk averse in terms of their medical training, but it's about taking structured decisions, safe decisions, getting the right kind of structure around your investment portfolio, and not delaying things until life settles down. A lot of people think, I'll just do it when the kids are older, or this is done, or my medical training's done. It's, as I said, you're missing out on so much opportunity along the way. So property investing is a journey, and the first step is today to get going.
Yeah. So looking back at my own journey, I think we got on the property ladder a bit early, but we've got a number of investment properties, and then I made some initial mistakes by not using structures effectively, so I'm sort of capped out in my borrowing capacity, which I'm trying to fix right now. Right. I'm obviously someone who has not as much aversion to debt. Is that the biggest problem you see amongst doctors? Because what we often see is that people would have completely offsetted their home loan, and that's the stage where they start thinking about investing. Is that something you see in your
It's not just the fear of debt. I think it's also because medical professionals are so well trained, they fall over themselves with what I call the disease of paralysis of analysis. They're kind of doing too much research, and they could invest in this area, they could invest in that property or that suburb or this, and they end up not doing anything because they're not satisfied in moving forward until all the parameters are solved. And at some point in their investing journey, you've got to make a decision to move forward and pull the trigger.
Do you say that, they want that perfection, and then that becomes the enemy of good?
I had the same thing. Right? Yeah. I was an economist, right? Yeah. And in my past life, and I'd get spreadsheets out and analyze all the different suburbs and everything to 3 decimal places. And then finally I said to my wife, we've just got to bite the bullet and pick an area and invest in it. And I've made a few mistakes along the way, which I now iron out and don't let my clients make the same mistakes. So, I've been the guinea pig down the canary down the mine in a way, and help people to make much, much more safer decisions. I think there's kind of, what's the word for it? Decision fatigue. People kind of just in their mind, they're just kind of like, there's so many decisions to make. I've got to get this right, that right. And it just kind of, becomes overwhelming, and they just don't allow the time.
You're never going to have perfect, is it? And the thing is that the longer you delay it, the more you lose out, I guess.
And then you watch the media, right? Yeah. Typically look back at COVID, right?
Yeah.
Commonwealth Bank came out at the beginning of COVID saying property prices could drop 30%, right?
Yeah.
What happened? On the Northern Beaches, they went up 38%, the complete opposite to what happened. So there's often fear-mongering in the media. You don't take your advice from media bites,
Oh, no, you can't do that, because and it's one of the things that where they say, prices are going to fall. Yeah, but if no one's selling, it's not going to fall.
Exactly.
And I think a lot of that was during COVID, now that we've lived through it, was that the rents did get hit quite badly for a lot of landlords. But if they weathered through that, it was all fine.
That's right.
Yeah.
That's right.
So it is what it is.
Yeah.
Okay, then, let's start with some positive stuff, right? Why is property, one of the most powerful tools. You mentioned leverage, you mentioned tax efficiency. But for a medical profession, what makes it so sort of unique?
Well, particularly for, I think, the borrowing capacity again. So medical professionals can buy typically 90 to 95% without paying lenders mortgage insurance. So immediately you can go to the bank with just a 5% deposit. You can leverage 50 grand. You could potentially buy $1 million property. That's a game changer. For other people, they've got to save up 200 grand, get a 20% deposit, which takes them anywhere from 5 to 10 years to save that amount of money. So medical professionals can rapidly accelerate the rate at which they buy and invest into the property market. So if you buy $1 million property today, and I'll just use simple numbers, let's say we buy a property in Brisbane, it's predicted to go up 10%. Next year, you'll have $1.1 million as a net asset, as a gross asset value. So that extra 100,000 you can then re-leverage into your next property and borrow against that. There's another 95 grand that you can use as a deposit for your next property. So it's a rinse and repeat strategy. So it's that leveraging ability, and the banks love medical professionals, right? They see them as low risk, right? Because they're high income earners, and it's just an easy loan for them.
Yeah. So I mean, my personal experience that when I was a much more junior doctor, it was a lot easier, but the banks have tightened things up quite a bit. So whereas now you probably the assessments are a bit tougher and it's a bit harder to get those loans now, but it's still possible. And you mentioned getting one or two, but that's the start of the strategy, isn't it?
Exactly.
The first 2
couple
to 3
first couple are
is
easy. First couple are easy, and then you got to get smart. This is where you've got to work with the team, which we'll talk about later. But getting the right broker, I know you've got the Two Birds, which are great brokers, and using the brokers to get the right finance, not just the property strategy, but it's getting the finance strategy right. That's critical. So it might be that you might buy 1 or 2 in your personal name, and then you might think about buying 1 or 2 in a trust structure, right? Then you might buy some in your self-managed super fund. So there's kind of 3 different streams in my mind as to how you can afford to buy properties, all with completely different borrowing assessments. So when you buy in your personal name, it's based on your personal earned income. When you buy in a trust structure, it's about the income that's earned from that asset you buy in that trust, right? And then in your self-managed super fund, that's a completely different entity again. They don't look at your personal borrowing capacity. Again, it's what the amount of equity you've got, amount of savings you've got in that super fund, and then the rental income and the yield from that property they'll lend on.
Yeah. And I think that's where I made some mistakes in my early career. I mean, we probably should have, delayed the last investment property, had it in a structure, because that's the one that really, really caught us in the end.
Yeah,
I mean, afterwards, my last property was a commercial one, which is an owner-occupied commercial, and that's all in structures, and that's all good. But it takes some time to recover if you get that bit wrong.
But it's okay. You can fix those sort of mistakes.
You can fix those. Yeah, eventually fix them up.
Yeah. But back to one other question about why property is so good. Fundamentally, it's a great hedge against inflation. We've had inflation running really high, but being in the property market, I look back at what I paid for properties 10 years ago and go, wow, I never expected it to be this high today. And so it's a great hedge. You're being well ahead of inflation, and the rents that you're earning on the properties, they're going to be ahead of inflation too.
So it's better than gold.
Oh, yeah, I reckon. Again, you can't leverage as high as gold. Right?
No, you can't leverage.
I mean, gold's great. I've got some gold stocks as well, but I think it's about leverage.
Yeah. And I think one of the other thing, as you mentioned, there's a lot of analysis paralysis, right? So when we look at all the different kinds of properties out there, and we're talking predominantly residential for today, argument's sake, there's so much variability in property. I mean, people talk about property as if it's one homogeneous asset class, whereas it's, as you know, it's every property is unique and every property is different. Unless you're talking about like a high rise with 100 units in there, then they're more or less the same. What is your take, and what do you believe is the right property? And perhaps they might not be the right property for the whole life cycle of a person.
Really?
At different stages. There's
a lot of, let's peel back the onion. There's a lot of in that
there's
question.
A lot, I know. It's a question and
the
question.
About buying the right property. So what might be right for you might not be right for your colleague. So what I'd firstly say is it's not a one-size-fits-all approach to property investing. Firstly, I'm going to ask you, if you're a client, I'm going to ask you, what's your income? What's your goal? What's your age? What's the outcomes you want? So I've got to pick what I call a retirement calculator spreadsheet, which I share with my prospective clients. And I say, in 15, 10, whatever years time down the track, what income do you want to earn passively from property? Is it 150? Is it 300? Is it 500? What sort of income do you want to earn? And let's reverse engineer the whole science here. Let's reverse engineer to how many, what value of property you need, and then how many properties within that value. It's not about the number of properties, but it's about the value of property and the yield that's spinning off. That's how the calculation works. So then it's a matter of breaking it down further. What is the right kind of property? So it could be a mix of resi and commercial, okay? And then with resi properties, is it going to be houses? Is it going to be apartments, townhouses? Is it going to be rooming houses? Whatever it's going to be. So I guess a couple of key pointers for the audience is I prefer to buy initially houses because of the land content. I've done a lot of analysis over the last 20, 30 years and found that houses tend to return a capital growth rate in Sydney, Melbourne, Brisbane, for example, of between 7.5% to 8.5%. So that's 7.5% to 8.5% capital growth return. And then you add on the yield of somewhere between 3.5% to 4.5%. So your total return could be somewhere around 12 to 2.5%, okay? Then you look at apartments, okay? Again, the same time period for those capital cities, apartments have returned between 5 to 5.5% capital growth rate. So by buying apartments, it's okay, but it's an inferior investment to houses. And you're losing about 2.5% per annum on capital growth rate.
But the yield's a bit better sometimes.
The yields are slightly better, but then you've got to compound that 2.5%. If you compound 2.5% over 20 years, it's a big number. So what I'm saying is, if you can get in and buy a good quality, low maintenance house in a growth area in a capital city, you're going to be doing well.
Okay. And when we get back to sort of the individual, somebody may not be able to afford something like that initially, because I think the mentality of most doctors is that I need to get somewhere that I can live in first, and then I start thinking about investing. I think that's the stereotype, right? Sure. There are more and more that are sort of open to rent investing, and one of the things about being a doctor is that there's quite a lot of I guess workplace mobility, because you got to move around quite a bit and sometimes go interstate. Sometimes.
Well, that's where, to be honest, Bree, that's where rent vesting comes into its own.
Yeah.
There's no shame in rent vesting. There's no shame in renting at all. In fact, it can be a much smarter strategy for a lot of people. If you are going to be moving around to different hospitals and different areas to service your clients, it's a great way to go, as long as you've got investment properties in good growth areas. And that's a great way. I see a lot of people do that. They have substantial portfolios, but they're just still renting. And then you can decide, 15 years down the track, when you want to slow down and settle down, sell off a couple of your properties and buy your home, your dream home, wherever you want to live. No shame in that.
Yeah. But one of the things is that with all the great first home owner sort of stuff out there, I think a lot of people are sort of fixated on buying that place. Getting that because it's stamp duty concession. The government assists you on that 5%. Even though doctors can borrow 5%, but my understanding is if you use the first homeowner grants from the federal government these days, you can still get that 5% loan, which everyone can access now, but your rates are slightly better, I believe. I think that's what
I'm not sure about the exact rates.
Yeah. So I think a lot of people want to do that, and then they live in their place, and it just becomes so easy. And they could do that strategy, right? They could buy their principal place of residence using the 5% first home buyer scheme, and then after 12 months, 18 months, they could sell it, or not sell it, but then convert that into an investment property if they wanted to. So again, that's another great strategy. So and again, none of this is like, there's no right or wrong for any individual. It's about what your individual circumstances are.
It's about individual circumstance, about your own individual goals. It's about your own risk tolerance as well. I get a lot of people come to me and go, oh, look, I can borrow $2 million, but I really don't feel comfortable borrowing $2 million. I only really want to spend about $1 million. I'm saying, why would you leave $1 million on the table? Like, it's crazy. You've got an extra $1 million borrowing capacity. You should be investing that. That's going to really help you to go forward. So don't be so shy.
Yeah. And do you see a lot of people being shy, or is it more that they don't want to buy one property for all of that, but they want to get one first and then get another?
I think some people aren't used to the process of buying multiple properties. They feel it can be overwhelming. They feel, how much time have I got to spend managing it? Am I going to get phone calls from the manager to fix things up? And am I going to have to do more spreadsheets? And honestly, it's like once you ride a bike, you learn how to ride a bike. Once you buy a property and buy multiple properties, you learn how to do it. And you can outsource everything. So I've got multiple property managers managing my portfolio. It hardly takes any time at all. So
Yeah.
and then you have kind of fears of, well, what if I get a bad tenant, right? What if they cause damage? What if they run away, right? So again, that can all be covered. You get landlord insurance with Terry Shear, $400 a year, covers you for all those kind of things, right? You get a good property manager that vets the tenant. They do reference checks. They make sure they've got good income, and that's a great way to do it. But I think the key for doctors is to use debt as a smart leveraging tool. Really use it as a smart leveraging tool, because that's what's going to accelerate your wealth plans. And your theme at the FICO conference is giving people choice, right? Do you want to work 6 days a week as a medical professional? Great if you do, but if you want to back off a bit, you've got a secondary source of income. And it kind of, I find for me, when I've got this extra income, it's kind of makes me feel more at peace. I feel more happier. I've got more options. Like I just feel more focused on what I do during the day, and I'm not as pressured.
Yeah. I mean, one of the things where how I justified to myself initially is that, it's going to have a family and, we have 2 kids, so they need somewhere to live.
Yeah.
And perhaps when they're old enough, we either sell them off, then they can buy what they want, or they can live in where we've bought. And that was sort of like the secondary thought behind the way we've invested, at least.
Okay.
Yeah.
I think, just on that point, a lot of people come to me and go, oh, look, if I buy an investment property near Sydney Uni or near Melbourne Uni for my kids, I think that'll be a good strategy. Don't you reckon, Rich? And I'm going, maybe not. I say, honestly, invest for yourselves and don't necessarily think your kids are going to live in it. You're better off to buy the best quality property that's going to generate the most equity. And then what you can do to help your kids is either loan the money, do what's called a limited equity guarantee loan, so you can loan the money against your property, or you can gift them money. You can get a refinance debt and actually give them cash. So that's an easier way to help your kids than tying you down to one particular location or property type just to think your kids are going to live in that property one day.
Oh, no, it's not they have to, but like if they can't be bothered or whatever.
And
And
the other thing I'd also say about this, what I did with my kids. So I said to my 2 boys, I said, look, I really want to help you get in the property market, get on the ladder. I'm not just going to give you money, guys. I said, I want to see you save money. So what I'm going to do is do a matching grant. I said, if you can save $100,000, then I'll match that with $100,000 myself. And so that's what my 2 sons have done.
Yeah, well, that's sort of educating them as they get older. So when did you start that, out of curiosity?
About 3 years ago.
3 years ago? Yeah.
So one son's there, my other son is on the way. Well,
on the way?
Yeah.
And I think recently one of your sons purchased a property, is that right?
Yes, last year.
Very first one? Yeah.
So
how was that experience?
It was fantastic. It was like, wow, and the younger one's done it before the older one. So
right.
It's funny that they've both got different attitudes to money. I won't go into it, but it's funny to see them. But, we used to talk about property around the dinner table, and I'd share some spreadsheets, and they've caught a bit of the entrepreneurial bug from me. They've both got their own businesses. So it's been great to watch.
Okay. And I guess, you're a buyer's agent. I remember back in the days when I started buying property, which is like around more than 10 years ago now.
Yeah.
Back then you could go on to realestate.com and look at a whole list. The rental yields were easily as good, if not better, than the interest you're paying.
Yeah.
You could pick anything off the street and have a view. It looks like a decent place. You could get it, and it was a reasonably good investment, right? But those days are probably long gone.
Yes.
And to find a good property is getting harder and harder.
Exactly.
And I guess that's where someone like yourself comes in.
Yeah.
Now tell me, what are the sort of, I guess, pitfalls? Because some people will be, I can just do this myself. What are the pitfalls to avoid?
Yeah. So you don't know what you don't know.
Yeah, of course. What are the things that you, in your experience, are the don't knows without giving too much away? Obviously.
Well, maybe, if I may, just go back to the first principle, and what are the criteria we should be looking for? If I can switch the question around, what's the criteria that an investor should be looking for? And then we can get to sort of the sort of red flags, if you like.
Yeah, sure.
I guess if you want to dumb down property investment, there's 3 things I look for. PIE. I look for population growth, I look for infrastructure investment, and look for diverse employment opportunities. So population, infrastructure, investment. So all those 3 things. So I want areas that's got a strong owner-occupier appeal. I want a location that's got a little more owner-occupiers than investors. So, and the reason I want that is the owner-occupiers really stabilize the market. If you've got an area that's got 80% investors in it, you're all competing with each other for the investor stock. Whereas you go to a suburb that's 70 or 80% owner-occupier, there's a very limited pool of investment. And you tend to find that the investors, the yields go up faster. So that's one thing I look for. I look for a property that's got good land component, good land content. I want a good yield. I want a low vacancy, shops, schools, transport, all those key amenities, and generally low maintenance, so the construction. So first thing I'm looking for is the location. Secondly, I'm looking for attributes about the suburb. And thirdly, attributes about the property. And that's sort of the ranking order that I look for in those three things. So I think for me, the red flags, if you like, is I don't buy high risk or very single niche properties. So I don't buy in massive high rise apartments where there's thousands of the same thing. It's ubiquitous, right?
Yeah.
Because if Bob and Mary and Sally all sell their properties tomorrow at a fire sale, what happens to the value of my apartment? It goes down, right? So I like to buy unique apartments or something that's got a special character appeal to it. I don't like heritage. Heritage is a red flag for me. Very difficult to get renovations or anything changed on the property. Maintenance issues, like I remember buying a lot of apartments for owner-occupiers around Kirribilli, and every single apartment block had a fire order on it from the local council, which is hundreds of thousands of dollars to get fire orders fixed. So they didn't have sprinklers and wooden staircases and fire extinguishers, and it was just crazy. So that's something to look for. Oversupplied areas, or what I mean by that is there's certain land releases. So what's an example? So the Ripley Valley, if you know that in Brisbane, it's west of Ipswich. It's a big area. I wouldn't be buying land in that area. There's just too much of the same thing. In Sydney, the southwest, you've got Luddenham, you've got Austral, Leppington, all that area is being developed. It's going to have great population growth, but there's just a lot of land to all be released at the same time. Yeah. It won't have the same line of constriction on land supply as buying in established suburbs. Okay. So if you buy in established suburbs, it's generally a much better thing.
And that's comes down to the location, isn't it?
Exactly. Yeah. Other red flags for me would be flood zones. So, Brisbane, first thing we look up is the flood map before we put any client into any property. Look at the flood maps, right? We also look in places like the Hunter Valley for subsidence. So I don't know if you know, but there's a lot of mine subsidence around certain areas in the Hunter Valley. So Singleton, Muswellbrook, you've got to get reports done, and you don't want a sinkhole in your backyard, basically.
Oh, right, yeah.
So that's a big thing. Yeah. Another thing is bushfire. Okay. So buying right on the edge of the bush, where you've got the what's the figure of the title, RPZ or protection zones. If you got to do a renovation, you got to spend about 10 to 20% more on your property because you've got to get certain types of fire ratings on windows and screens and all that sort of thing. So be aware if you buy in those kind of environmentally sensitive zones, what it's going to be. So same as when you buy in northern Queensland, like if you're buying in Mackay or Yeppoon or whatever, yes, you might get a cyclone. Not to say you wouldn't buy there, but just be aware that the insurance might cost another $500 or $1,000 a year. So just be aware of those things before you go into it. Other big things, big risk factors in strata properties, special levies. So like beachside apartments, often there could be concrete cancer that's not diagnosed, or some of the old inner city buildings used to have water penetration problems. Just get the strata report done, check if there's a history of issues, check if there's any special levies, because that can be a game changer for you.
Yeah, and that applies for houses as well, along the beach and all that sort of thing.
Correct.
Yeah. So and then it just comes down to the numbers, is it?
Yeah, and then exactly. And then I guess doing it on your own, right? Everyone can do it on their own, right? But at the end of the day, how much time have you got to commit to finding a property, researching the market, getting to know the value of the area? So you can jump onto realestate.com or Cotality and get a median price. But often it can be very misleading. And often, even if it says the median price in Bondi or Manly is X for this month, it's often behind. It's because it's looking at historical data. Yeah. It's lagging data. So you've got to be on the ground, going to auctions every week, seeing what's happening with agents, seeing how they operate. And that's the other thing, working out how agents operate, right? Dealing with agents is a whole other, we could do a podcast about that. It's a whole other ballgame. Yeah. And understanding how they negotiate is really interesting. I did actually on one of my podcasts recently, I interviewed Adrian Bowe from the Eastern Suburbs, and I talked about the psychology of negotiations and got some great intel from an agent's perspective, right?
He's a
selling agent.
He's selling agent.
Yeah. And it was fantastic. It was the most enlightening part. He was so honest about it. It was refreshing, right? I mean, they're there to get the highest price for the vendor, right? Yeah. and they're going to milk every buyer for what they're worth, right? But there's strategies that we use as buyers agents to get our clients ahead of the competition and close out the deal faster. Because we come prepared, our client's finance approved, ready to go. We're a professional talking to another professional. We get a deal done a lot faster. So our average turnaround time is 30 to 50 days after a client engages us to when they've bought a property. The average DIY or person buying on their own is somewhere between 6 to 12 months. The problem is we're heading into a market next year in 2026 where the market is going to accelerate across all capital cities. Some capital cities will go 10 to 15% price growth. So if you take 12 months to buy, you could be 15% behind. So there's a kind of a requirement, not a FOMO, but almost a FOMO situation where if you delay, you'll really be behind the 8 ball.
Yeah, yeah. And you know, all those things that the analytics you talked about, how much of that is available to the average Joe?
Good
the
question.
Average buyer?
Not as much.
Yeah.
So we use a lot of AI tools and also analytical tools. So we've got our own proprietary research data. Then we use other platforms like Microburbs, which details, it's got unbelievable data points. It looks at crime stats. It looks at everything in the suburb. We use Suburbs Finder, which gives us a really good narrowing down of all the parameters in the suburb. We use hotspotting, which particularly looks at a lot of infrastructure and employment and demographic statistics. And obviously we use Cotality. So we use that to find all the comparable sales. But then you've got to apply all of that sort of statistical knowledge and put a layer of what I call practical analysis over it all and watching just how the market is working. So, you know, for someone to subscribe to all of those platforms would cost them maybe $3 or $4 grand a month. So we provide all of that to our clients as a neat package. Yeah.
Well, I guess a lot of them is like they're B2B software. They're not
Exactly.
really for the
consumer could buy it if they wanted to, but then how do you interpret it as well?
Yeah, and
there's a
it's
whole
also
level of
expensive as well.
interpretation, you know, because within a suburb, well, there's typically what I call golden triangles. There are certain areas or certain streets within suburbs that always have a superior price. So what's an example? So the North Shore of Sydney, right? Everything on the eastern side of the railway line typically sells at a 5 to 10% premium to everything on the western side of the highway. Why is that?
Why is that?
Exactly. I knew you were going to ask me. It's two things. One is historical.
Yeah.
Two, it's landform. Because on the western side, it tends to slope away better. A lot. So there's a lot steeper. So when you go into the gullies, the properties aren't as flat. Whereas on the eastern side, it's a lot flatter and it's kind of where the major schools are. It's just historically typically a higher price.
Now that you mention it, it makes sense.
And there's certain pockets, like in certain suburbs, like there's a village shopping centre. All the streets surrounding that village shopping centre within like an 800 metre radius typically have a higher value because it's got higher amenity. You can walk to the shops, buy your groceries, get your milk for the day.
Yeah. And I would assume something like 10, 15 years ago, these software platforms weren't as readily available.
Not at all. They haven't been invented yet.
Yeah, exactly.
And there's AI as well, but you got to be really careful with AI.
Yeah.
A lot of people coming to us and they've kind of created their property brief using AI and it's actually unrealistic. We have to correct it. So, there's 15,000 suburbs in Australia. I don't know if you know that, right? 15,000 suburbs. So how do you pick which one to buy in? As I said, there's both technical and fundamental analysis. So the technical is just all the data points, looking at all of that. And then fundamental analysis is really what I call our own applied knowledge. So applying an element of sensibility and track record, knowing, who's moving in, who's moving out. The demographics of a suburb are particularly important as well. Really important.
Interesting. Yeah. And it sounds like one of the reasons why back when I started investing was so easy because we didn't have these tools. There wasn't a arms race.
Yeah.
In a way.
Yeah.
And because property is obviously a very hot commodity in Australia.
That's right.
They built all these data analytic tools and it's getting, without these tools, it's getting harder and harder to find the right property.
Exactly.
Is that your 100%. Experience over the last 10 years?
Absolutely. It is getting harder. Like some interesting data for you. I do a lot of presentations, as you saw at the FICO conference. I think one of the slides I put up was the volume of listings over the last 5-10 years. Listing volumes have been trending down. They're now at 20% below the 5-year average. Again, why is that? I keep asking Tim Lawless, the head of research. Tim,
really?
Why are listing volumes 20% below the 5-year average?
Yeah.
And he said, Rich, people aren't moving as much. I think stamp duty is a huge impediment for people selling.
Yeah.
People are aging in place more. And it might be people can't find their next property. This is what I call the Mexican standoff. So people are going, I want to move, I want to downsize, or I want to upsize, but I don't want to sell because I can't find my next property.
Yeah.
So there's kind of stalemate happening in the market as well. At the moment,
and because of this, because of the stamp duty, the barrier to entry and exit is just so high.
It's massive. You don't want to make a mistake. If you're selling a $2 million or buying a $2 million property, what's that, 150 grand in stamp duty? It's huge, you know?
Yeah, 20%.
It's a big number.
That's a big drop. Yeah.
It does fluctuate during the year. We get these peak selling periods between sort of late February to April. So that March, April periods are high. And then we get a big selling period in spring. So September to now to November, again, a big selling period. But during the year, if I was selling a property, I'd probably sell it in winter because there's a lack of listings, lack of competition. It's probably a good time to sell.
Yeah.
But at the end of the day, you just got to sell when you need to sell.
Yeah, yeah. I mean, do you see, because, if you're telling me the trend is generally less and less listing, do you ever foresee the local state government changing that whole stamp duty thing for the better?
Oh, well, you know, what's the name? Dominic Perrottet, the previous premier, tried to, right? Remember he introduced, you could either pay stamp duty up front or annual land tax. They introduced it. They got it going for 6 months. It was brilliant. It was a great idea. And then they got booted out and then they got canned. So good on them, you know, for having a crack at that. So it just takes a brave government to, you know, because most governments are addicted to stamp duty. It's such a strong revenue source. It's a massive revenue source,
right?
You know, and it's not, it's, you know, as property prices go up, they just get higher and higher stamp duty. It's, you know, it's not indexed properly. Right? I think it's definitely a huge barrier to entry. And I don't know if governments are going to have the balls to do it again.
Yeah, that's interesting. And one of these things is that with the changes at times, you know, prices, the way the market works, and government, a 20% drop in revenue is going to be horrible.
Well, they'd done some modeling to work out they were going to kind of break even after a certain number of years. So.
Oh yeah, but like even now, if there's less transfer, and that's why some of the states are broke because they've lost a lot of stamp duty revenue. And we don't know. I guess as a like, I call myself a bit of a pundit. Like, do you think, like, what are the circumstances that you think will, the government will have an appetite to revisit that again? Or do you think that's just something that's just in the too hard basket?
Well, I think at the moment it's in the too hard basket. I look at Victoria, it's a bit of a basket case in terms of their economy because they're kind of a lot of debt. You know, they really got smashed during COVID. And what they did about two years ago, or they decided to increase land tax. So the threshold, it starts at 50 grand, right? So they're just, again, targeting property investors, cheap way to get money. But a whole stack of investors sold their investment properties. I can't remember the number, but tens of thousands. I think it was 25,000. And the rental bond board was flooded with refunds, and so that really created a bit of a shortage in rental properties there. So, but again, it's not a reason not to invest in Victoria either. It's not a huge amount more, but it is a bit.
It took a little hit for that 12 months or so.
That's right.
But then more people actually then just bought into it, and they converted some people from renters to owners. So at the end of the day, it still satisfies the thing, right?
Yeah. The political spectrum, it's like, taxes is just, everything needs a revamp.
Everything needs a revamp.
The problem is they're doing it in piecemeal, and you've got state taxes, federal taxes, it's very piecemeal. So that's where you need a good accountant to help you navigate that.
Yeah. And one of the things, pulling back a little bit, just looking at the whole environment, because property investing is a 20, 30-year game, obviously.
Exactly.
We need to think about where the legislation and all of that stuff is hitting into the taxation.
But that's not a reason to not invest.
It's not.
I think a lot of doctors and other people use that as an excuse, going, they're going to change the super laws, they're going to do this. I just sit on cash.
No.
And that's going to be the worst thing you can do.
Of course. But the thing is that I think we need to, because we're here talking about it, at some stage in the next 30 years, what we're talking about today is not going to be applicable anymore. True. And they're going to change all these
this
things.
is where you got to have an adaptive strategy.
Exactly.
Yeah.
And you got to work with someone, professionals who can foresee what's coming, and you can plan around it.
Correct.
Right? It's just like what they've done with the superannuation.
Yeah.
You can plan around those things. You don't have to worry too much.
That's it.
As long as you have a adaptive strategy and be flexible about it and not let those things derail your strategy.
Correct.
Yeah. So I guess one of the things we often hear is that, there'll be these couple of people that have 5, 10, 20 properties, right? Whereas most investors in Australia will have 1 or 2 investment properties. I think the mode is probably still 1, right? The average mom and dad investor will have 1 property. Most doctors will have a couple. I'm not sure what the actual data on it is. How many investment properties most doctors have. I think that might be an interesting survey to do amongst our community. But getting from 2 to 3 to 5, 10, 20, that's a completely different strategy, isn't it?
It is.
And as we touched on, you got to start using structures. How does someone go from the 2 to 3 to 5
Excellent
plus?
question. So firstly, it's mindset. It's literally having a team around you that's going to support you with your goal. Getting clear about your goal, firstly. It's going, and as I said before, it's about reverse engineering. If your goal is 300K as a passive income, how much property do you need, and how many properties within that value do you need? So
let's say the sky's the limit.
Okay, sky's the limit. But I think
how would you go?
A lot of people think it's impossible to get 5 to 10 properties. So I would say choose your goals, and then it's about filling in the blanks. It's like a piece of the puzzle. Okay, so we've got 2 properties now. Let's leverage the equity you've got from that. Let's get a pre-approval to buy the next one. Okay, so and then it's balancing the yield and the growth factor. Those 2 things are critical. So you've got to keep your borrowing capacity relatively high, as your issue is yourself. You've run out of borrowing capacity. It stalls you for a period of time. So I recently did a review for one of your other doctor clients recently. And I won't use any names, but they had a really weird portfolio. They actually had 9 properties and a lot of apartments in all weird. And I kind of asked, why did you buy these? And it's like, oh, well, some tip from this thing and some tip from this magazine. There was no structure or rhyme or reason. So I've recommended, we've done a thorough review, thorough analysis. I recommended they sell 2 properties because they have low growth prospects. And sometimes it's about getting rid of the underperformers in your portfolio so you can then reinvest that capital to then go ahead. It's also having a mindset of, a lot of people go, I won't leverage against my own home. I just don't want to touch my home. Honestly.
The owner occupied.
You're owner occupied. Honestly, you have to do it.
That's the easiest.
It's the easiest leverage you've got. And it's easy to quarantine the amount you borrow against into an offset account so you can for tax purposes. So have that mindset of using your available equity. Otherwise, it's dead equity. So that's going to slow you down if you don't go that approach. So it's very possible to buy, 10, 15 properties over the course of 10 to 20 years in your medical career. And then it's a rinse and repeat strategy. As I said before, you buy a property every 1 to 2 years, you revalue that property, go back to your broker, say, hey, look, I've got another 200K. My income has gone from X to Y. I've got a bit more income. Can I go again? Sure. And in that time, what's surprising for me is my rental income keeps going up, right? And that helps you with your borrowing capacity. So as I said before, it's a matter of getting both growth properties and higher yield properties that helps you to be creating a self-sustaining and a scalable portfolio. So I think in terms of an overall plan B, the first couple of years, it's about getting a good asset base and getting that equity. It's really about getting growth, minimizing your tax, using a tax-efficient process. And then in years 3 to 6, it's about unlocking equity, diversifying across different states. A lot of people get stuck and just want to buy in my own backyard. Don't. You've got to be a borderless investor right across Australia. And then that's
the land tax.
And that's the land tax strategy. And then it's about bringing in more yield into the portfolio. So it might be you add a granny flat. It might be we buy dual income properties. It might be we buy a rooming house. It might be we other kinds of, or a commercial property. We bring in other kinds of properties with higher yield. And then when you get to like year 10 to year 15, it's then about rebalancing the portfolio. Again, you just do a reassessment and go, hey, do you want to keep working 5 days a week, or do you want to back off to 3 or 4 days a week? Maybe we sell a property, pay down some debt. That'll just release the pressure burden, right, in terms of the servicing all the loans. So that's kind of what I call the maturing phase. It's about getting the asset base right. It's about getting the right combination of yield and growth. And then finally, it's about rebalancing. So I put up a slide again on the FICO with that triangle with those three kind of elements to it.
Yeah. And so it sounds like doing that all by yourself is pretty difficult.
I wouldn't advise it. It's like going to Nepal, right, on a trek, and how are you going to get up the mountain if you don't know the way?
You get a Sherpa.
Yeah, you get a Sherpa or 2.
So I guess the team that you need around you is you need a good accountant.
Yes,
because they can help with all the structuring.
Correct.
You need a good broker that can work with the accountant to to get the right things.
Yes.
And then is a hopefully a buyer's agent like yourself.
Absolutely, yeah. You need a buyer's
help you
agent.
find the places.
Well, to execute,
Yeah.
you need a buyer's agent help you with the strategy around the property, help you to execute it. You're also going to need a good solicitor. Again, we recommend one that's licensed in each state. You'll also need a building inspector to get your pest and building done or strata reports done. You also want a good quantity surveyor. We can recommend people to do a good QS report so you can maximise your tax deductions. And as I said, great accountant and great broker.
Yeah.
Very important parts of your team.
Yeah. So it's and it sounds like all these extended people tend to come from the agent, the buyer's agent.
Yeah, we've got a really good team.
Yeah.
Yeah.
Yeah. And
All
so
independent part, not a part of our business, but all independent businesses, professionals. Yeah.
and that's right. And then to do all of that yourself is just like you got to be managing like 6 different people. It's just very difficult. Yeah.
Too hard.
Yeah. Awesome. Before we finish, any sort of final words of advice for those that are, stuck at 1 or 2 and really want to get to the next level?
Good question. I think maybe a couple of case studies, if I may. So I think it's really good to sort of look at inspiring people who've walked the path before you and think, gosh, if they've done it, I can do it. It's not that hard. So years ago, I've forgotten his name now, we had a lovely paramedic who came to us to buy his first property. And again, really nervous about it. He was earning modest income as a paramedic. And then he bought his first property. It did really well and went, oh, this is fantastic. And he told all his friends and all his friends started using us. Anyway, he ended up buying 5 properties in 6 years, and he's done really well.
Wow. Okay.
So he's done really well. We had another guy called Michael. He bought his first property in 2016 for 580 grand, started in Western Sydney. Now he's leveraged across 3 states and he's got a portfolio of 4.2 million now and 160 in rental income per annum. Yeah. And then we've got some, not a doctor client, but some really high net worth clients as well. We've got a guy called Jamie. He's got 25 properties. His goal was to replace his earned income that he earns from his professional advisory business with property income. And he's way exceeded that. He's earning over about 1.25 in million per annum in rental income now. So it's achievable. Our most prolific client has got 50 properties, and we just help them buy one every year or a couple of years. Yeah.
And that's all obviously all structured.
Yeah, exactly. I mean, I've got a couple of high net worth clients and I'm doing structures for them right now about buying the right kind of properties in the right kind of states. So I guess final bit of advice I'd say is start earlier than you think. Get started.
As soon as possible.
Yeah, get started and set the goals. You don't have to have all your goals perfectly laid out. It's not about perfection with your goal. It's just a general goal. Look, the goal might be, hey, I want to retire in 10 years, or I want to have the choice to retire in 10 years or 15 years, whatever it is. Focus on high quality assets. Don't buy inferior properties. Get the best quality of property you can.
Yeah, especially the first couple.
Especially the first one. The first property you buy, the leverage off that first property is critical. And people who buy the wrong property, they might buy an off-the-plan house and land package in some greenfield area that's oversupplied and it's a slow grower, or they've bought back in the day an inner city Brisbane apartment that went nowhere for 10 years and now it's just coming out of the doldrums, but don't do that. Use debt intelligently, use debt smartly, leverage it to the highest capacity you can, but leverage it safely. Follow a plan, don't read the headlines, and let time and leverage do the work.
Yeah. And I think you said it brilliantly. Just the first property is the most important and to get in as soon as possible. And that applies to new doctors that are starting out next year as interns, residents. If you haven't thought about it, get in on it early because...
And if I may, one last thing to finish with, I actually bought the predictions, which just came out yesterday.
Okay. Let's have a...
So there's 2 sets of predictions. So Domain, Nicola Powell from Domain just brought out her predictions in late last month, and she's saying that Sydney will lead the charge, do 9.9%. So Sydney's median house price, 1.75. She's saying it'll go to 1.92 million by the end of 2026. So her predictions are
the median house price.
Sydney will do 10%, Melbourne 8%, Brisbane 8%, Canberra 7%, Perth 6%, Adelaide 5%. Okay, so I consider those conservative assumptions, but it's interesting. She's put Sydney at the top of the tree. Now, Louis Christopher, who is one of the best property researchers I know personally, I interview him quite a bit. He just released his boom and bust report yesterday. So here's his numbers. He does a range, okay? He doesn't give a specific number, and he based it on 3 different scenarios. So his base case, where he thinks there could be possibly one more rate cut late next year, and there's going to be a slow economy, inflation will be modest. He thinks Perth will lead the tree, 12 to 16%.
12.
Brisbane, 10 to 15%. Darwin, 12 to 16%. Melbourne, 4 to 7%. Sydney, 3 to 6%. Adelaide, 10 to 14%. And Hobart, 4 to 7%.
That's like the opposite of the other person.
Exactly. It's quite different. But interestingly, the average across all capital cities is a 6 to 10% rise. So I'm writing my newsletter at the moment, and as I'm saying, the only way is up. Not being an optimist, but literally we're going to see, anywhere from, a 5 to 15% growth rate in property prices next year.
Yeah. I don't know. It's just getting more and more unaffordable.
Yeah. Well, it's either get in or stay out.
Yeah, that's right. That's right. So I guess concluding statement I got to say is for those that may not feel they're ready, have a look at it because you want to get in as soon as possible. And the crucial thing is make sure you get the right first property.
Correct. Yeah, absolutely. Yeah, don't over leverage, but talk to your broker, work out what you can borrow, then we can work out a strategy. And then it's literally about, executing that strategy and not panicking. Don't worry you're going to miss out. There'll always be a good deal. But the sooner you get in, the better off you're going to be down the track.
Yeah. Awesome. Thanks for joining us again.
Thanks,
Rich.
B. Pleasure.
This podcast is for educational and entertainment purposes only. The information and opinions shared are not intended as personal financial advice. The content presented should not be relied upon for making financial investment or other decisions. Listeners are strongly encouraged to seek the advice of qualified financial or legal professionals before making any financial decisions. While we aim to provide valuable and accurate information, we make no guarantees regarding the completeness or accuracy of the content. Any reliance on the information provided is done at your own risk.